When you hear the name Warren Buffett, you probably think investing genius, right? But what if I told you his entire massive philosophy boils down to a few simple principles? Principles that even a 10-year-old could get. Well, that's exactly what we're going to do. We're going to break down the 7 simple rules that made him an absolute master of the market. You see, pretty much everything Buffett does today, it all traces back to 2 habits he picked up as a kid. And the story doesn't start in some fancy office. Nope. It starts at a horse racing track. So get this, when he was just 10 years old, a young Warren Buffett would go to the Oxarbin racetrack in Omaha, but he'd go after the races were over. He'd spend hours sifting through thousands and thousands of discarded betting tickets. Why? Because he was convinced that in all the excitement, some people must have accidentally thrown away winning tickets. And you know what? He was absolutely right. He'd find them, get his aunt to cash them in, and just pocket the money. So that racetrack story, it's not just a cute anecdote. It perfectly shows his first core habit, just incredible patience. I mean, imagine a kid doing that. His second habit, knowledge, came from a totally different obsession. He would spend all day, every day, just reading these thick, boring books called Moody's Manuals, which were filled with the financial details of public companies. So, patience and knowledge. Seriously, these 2 things are the bedrock of everything else we're about to talk about. All right, let's dive into our first big theme, and you'll see how this all connects. This rule is all about keeping things simple. In fact, it's probably the most famous Buffett principle of all. Only, and I mean only, invest in what you actually understand. So you might be thinking, okay, sounds good, but does that really work? Well, what's the best proof I can give you? How about a story about a 7th grade investing club? Yeah, you heard that right. A group of kids from St. Agnes School. Turns out these middle schoolers didn't just dip their toes in the market, they absolutely dominated it. Just look at this chart. It's kind of mind-blowing. Over a 2-year period, these students got a 70% return on their investments. 70%! For comparison, the S&P 500, which is the benchmark for all the so-called seasoned professionals, only returned 26% during that same time. So how on earth did a bunch of 7th graders do that? Well, their secret was just one simple rule their teacher gave them. They were not allowed to invest in any company unless they could explain in really simple terms what that business actually did. That's it. So no complex tech, no confusing financial instruments. They just invested in brands they knew and understood, which really proves you don't need a PhD in finance to make smart decisions. Okay, so rule number 1 is clear. Buy what you understand. Makes sense. But how do you actually go about picking those stocks and building a portfolio? Well, this next section gets into the practical how-to part of the strategy. Now, here is a really crucial point, something you might not have realized. As a small individual investor, you actually have an advantage over the big guys. Think about it. For a massive company like Reliance to grow 10 times bigger, that's almost impossible. But for a smaller, solid company, a 10x growth is much, much more likely. And this is where you can find these incredible opportunities that the big hedge funds often have to ignore. Why? Because these smaller companies are just too tiny to move the needle on a multi-billion-dollar portfolio. And the best part, you don't need to find hundreds of these companies. Buffett himself has said that all you need to do really, really well in life is to find just 3 wonderful businesses. 3. See, the goal isn't just to diversify for the sake of it. It's about concentration. It is so much better to own a small handful of companies, we're talking maybe 8 to 15 max, that you know inside and out, than it is to own 100 that you barely know anything about. Your knowledge is the real edge here. So where do you find these amazing companies? Honestly, just by opening your eyes and looking around you. The legendary investor Peter Lynch, he noticed his daughters were suddenly obsessed with a store called The Body Shop. So he looked into it, and what did he find? It was a profitable, growing, publicly traded company. He invested and made an absolute fortune. We saw the same thing happen in India with Royal Enfield bikes. The best ideas, they often come from our own everyday lives. So if you see a product that people are going crazy for, there's a good chance you might end up loving the stock too. Okay, so now we're getting into the more analytical side of things. Let's say you've done it. You found a simple, smaller business with a product that everybody loves. How do you actually judge if it's a healthy company and a worthwhile investment? First things first, and this is a big one, stop trying to time the market. Seriously, trying to predict what the stock market is going to do next week or next month, it's a fool's game. You just can't win. The best investors know that long-term success doesn't come from guessing the market's zigs and zags. It comes from owning a piece of a truly great business that is just steadily growing year after year. Eventually, the stock price always follows the business's success. So if you're not timing the market, what should you be looking at? Well, what's the single most important metric for judging a business's health? According to Buffett, it's something called free cash flow, or FCF. Now, this is a little different from just profit or even cash from operations. Free cash flow specifically subtracts the money a company has to spend just to maintain itself, things like buying new machinery or building new factories. It's the real leftover cash that the owners could, in theory, just take out of the business without hurting it. It's the honest number. And this slide right here shows you just how big that disconnect can be. Look at Reliance in 2021. They reported a massive profit, over 49,000 crores. On the surface, that looks amazing, right? But their actual cash flow was negative 13,500 crores. That tells a completely different and much more important story. This is exactly why you have to look beyond that big flashy headline profit number. Let me put it in really simple terms for you. Here's the whole concept in a nutshell. Imagine your business makes a profit of 1 crore. Fantastic. You're celebrating. But in order to keep the business running next year, you absolutely have to buy a new machine that costs 99 lakhs. So yeah, your profit on paper was 1 crore, but the actual cash you can take home, your free cash flow, is just 1 lakh. That is the number that really truly matters. All right, so we've covered a ton of ground here, right? We've gone from his childhood habits all the way to key financial metrics. So let's bring it all home and summarize Buffett's 7 timeless rules of investing. So here they are, all in one place. Number 1, learn a lot, read a lot, be a learning machine. 2, know what you own, simple as that. 3, buy smaller companies if you want that long-term growth. 4, only hold the number of stocks you can actually stay informed on. 5, if you like the product, you just might love the stock. 6, don't time the market, focus on the business. And number 7, the big one, free cash flow is king, always. You see, none of these rules are about complex math or secret algorithms. They're really just about patience, knowledge, and good old-fashioned common sense. So as you look at this list, the real question I have for you is this: which one of these rules are you going to use to begin your own investment journey?